Hey there, financial snoozers. Today, we are talking about the so-called boring investments, ETFs. Yeah, I can already see you stifling a yawn, but hold on to your pocket protectors because this ride is about to get wild at investing with Tapan. So when you're playing this video game and you have this awesome backpack which can hold on to a bunch of things such as snacks, gadgets, and who knows, maybe even a pet rock. Well, consider an ETF as just like that magical backpack. ETF stands for Exchange Traded Fund. Now I know it sounds like a very difficult word, but trust me, it's the easiest investment available for investors like you and me in this complicated world of finance. An ETF is just like that magical backpack. It can hold a bunch of stocks or a bunch of bonds and you can own that backpack, but not the whole backpack because that will be too expensive. So you can own a small part of that huge backpack. An ETF is also called a basket of stocks. Because you can put a lot of stuff in it. So therefore, when you buy a small piece of this basket, you are essentially owning a small portion of all the stuff inside this basket. So who makes these baskets, you ask? Well, there are many authorized participants in the market who can make these baskets, such as Vanguard, BlackRock, iShares. You don't know of them? How about TD, BMO, Scotia, RBC? I'm definitely sure you must have heard of them. These companies make various types of ETFs. Hold your horses. Various types?
I thought ETFs just put stocks in a basket and then I can buy a piece of that basket and enjoy my life.
Well, let me give you an example. When you are going on a picnic, you have this one basket. Would you put hot soup and cold drinks in the same basket? Technically, you wouldn't, because the cold drink will make the hot soup cold and the hot soup will make the cold drink hot. Right? So similarly, why should you put completely different types of stocks in the same basket? Each ETF is designed to achieve a goal. Some ETFs focus on indexes such as S&P 500. Some ETFs focus on dividend stocks. Some ETFs focus on bonds. So let me ask you this question now. Let's say you want to make an ETF who pays good dividends to its unit holders. What would you do? Would you put a company that does not even pay a dividend? You will not, right? Because if that company is not paying the dividend to the ETF, how will the ETF pay to the unit holders? Instead, you will put good dividend paying companies in that ETF so that they can pay you regular dividends and you can distribute that to each of your unit holder. By the way, unit holder is just like a person who owns a little bit of the ETF, like investors like you and me. A company has shareholders, but an ETF has unit holders. Now, if you just started investing, you must have heard a lot of people say this to you.
Buy the S&P 500 index and do nothing else.
If somebody tells you buy the S&P 500 index and do nothing else, either they're being too casual or they don't know what they are talking about. Now do me a favor, Google S&P 500 index. Something like this will show up on your screen. Well, listen. You cannot really buy the S&P 500 index. The S&P 500 index, it basically tracks the valuation of the largest 500 companies in the United States. But what you can buy is an exchange traded fund which is based on this S&P 500. To put it simply, the ETF will have all the exact same 500 companies as the S&P 500 in the same proportion as the S&P 500 has. Meaning, if you're buying one piece of an ETF which tracks the S&P 500 index, such as Vanguard's VFV, then you can be a small owner of all the 500 companies in the United States. We will talk a lot more about what S&P 500 is in the future video. For now, just know that there are ETFs which track indexes, there are ETFs which focuses on capital gains, there are ETFs which focuses on dividends, emerging markets, bonds, and whatnot. Also, there are ETFs which focus on specific sectors like bank, tech, and others. So what are the advantages of even buying an ETF? The first advantage is that it will help you to diversify your portfolio. When you buy one unit of the VFV ETF, you are essentially having 500 companies in your portfolio, even though in small portion, 500. So even if one of that 500 companies go bankrupt, you will not have to worry about it because there's 499 other companies. Whereas if you're owning individual stocks and if that company fails, then well, you are in a problem. Advantage number 2, it is low cost. Unlike mutual funds which are very expensive, ETFs are low cost investment options. Their expense ratios are less than 0.5% and sometimes even less than 0.1%. So the less the costs, the higher the profitability. Advantage number 3, you can sit back and relax and not worry about your financial future, because you know that the ETFs you invested in are very diversified and good and posed for a long-term high return. Last but not the least, number 4, it is very easy to do research on an ETF. Now, even though I said it's easy to do research on an ETF, you still have to do a research on any ETF or anything that you're buying. Research is still needed, my friends. You'll have to see which stocks are in that ETF, what is that ETF aligned to your personal goal. If your personal goal is to get a consistent dividend income, then you will not go and buy an ETF in emerging markets. You will buy an ETF which focuses on dividends. So you will still have to do research on it, see if they are aligned to your goals or not, see their track record, how long have they been in existence, see which companies are providing that ETF to you. If it's Vanguard, BlackRock, TD, Scotia, BMO, RBC, good. If it's a random company that you've never heard of, be wary of that. Now, sometimes the playground will get a little bit rainy and thunderstorms will hit, and your ETFs will also go down in value. But instead of throwing out that basket, take a deep look inside that basket and see what is inside that basket. Are the apples and bananas and oranges good? If they are, then there is no need to throw out that basket. The basket is just wet. It will soon dry off. Remain calm when things go crazy. There are times when ETFs with very few stocks can become a risky investment. So it's always important to do your due diligence. Always be very cautious of what you are buying into. Just don't buy something because a random guy on YouTube or a random guy on the news told you to buy it. Instead, do your research, learn about it, read books, because that is what will help you on your journey to financial success. Alright my friends, if you learned anything from this new ETF video, be sure to give this video a thumbs up, subscribe to the channel, and until next time, stay motivated, stay invested, and remember, even the financial markets cannot resist a good laugh.